I'd like to thank everybody for coming this evening. Our topic is bull and bear markets, so I don't think I have to talk that up to anybody. It's an interesting topic. It's something timely, certainly on the minds of anybody in finance. So let me, before I get into things, mention that I've been working with Tom McCurdy on these issues, these topics, for well over a decade. And the recent work that I'm going to talk about tonight is also was joint work with Yong Song. Okay, so here's what I'm hoping to go through tonight. We'll talk about the data. Then we'll talk about some dating algorithms, so how we might go through and produce a sequence of bull and bear markets using historical data that you might see in the newspaper, for example. We'll talk about then an econometric model, which is called the Markov switching model. We'll look at some applications of historical time periods to see if any of the stuff makes any sense. And we'll finish off with recent market conditions and where we are. Every time I present this sort of stuff, I have to say something. I get a question, where are we now? So I now anticipate that all the time. So we'll say something about where we were at least up to last Wednesday, and then we'll finish off. Okay, so here's our data. We're using a long time span of data, and that's important. We're looking at cycles in stock returns and a broad index. And of course, the more cycles we have, the better we're going to be able to understand these things. So we're looking at capital gains from Bill Schwert. That's an index he put together. Includes lots of railroad stocks, insurance company, bank companies. It was not particularly well diversified, but that's what was available back then. That's then spliced to the crisp S&P 500 index, which they've produced back from the early 60s. And then following that, we've got just S&P 500 data after that. So we're going to be looking at weekly returns here, and they're going to be continuously compounded Wednesday to Wednesday in general. We're also going to have some data on realized volatility. Realized volatility is really just taking daily returns, squaring the return, and summing it up. And that gives us a very accurate measure of volatility after the fact. So that's what we call that ex post volatility. And so we're not going to use that in our models, but we're going to use it to help us understand, was volatility of the market high? Was it low? Is it telling us something about a bull or bear market? We're going to look at percent data, scale the data by 100, and here's basically the return statistics that we have from 1885 to 2010. So there's the mean, the standard deviation, the skewness, and kurtosis. And if anybody remembers some of their basic statistics class, these sorts of things indicate that we're dealing with a non-normal distribution, a non-Gaussian distribution. And we've got about 6,500 observations. So here's the problem we face. You look at this sort of a picture, and it's pretty clear that there seems to be trends in the data. Okay, there seems to be trends in the data. We've got some periods here. So this is the 29 crash. Prior to the founding of the Fed, there was all sorts of bank runs. There was stock market downturns that would turn into problems in the banking sector. So there was lots of issues in there. There was a panic in 1907. You can see over here, I think that's the 87 crash. That's probably one of the biggest single-day crashes. I'm not sure on a weekly level if it is. There's our recent problems right now, too. So what we want to do really is to try to model these trends and think about bull and bear markets. So that's our task. So the first thing that people started doing is Adrian Pagan and Susanov went to the GDP literature, the gross domestic product. They started looking at how do we sort the data into business cycle, because really this is a very similar problem. We're looking at peaks and troughs, just like the same idea with growth rates and GDP. And so they came up with a simple algorithm, and I'm not going to go into the details. They have a method of going through looking at peaks and troughs and sorting it, and you can see the details. And that gives us one way to sort of ex post sort the data. Another approach by London Timmerman is slightly different. They have a cutoff rule of 20% increase or decrease for the beginning and end of markets, and they have some rules about windows. And that gives us a second approach, and you could come up with all sorts of different approaches, but let's just see what this would give us if we apply this to the data. So all of the stuff I'm going to show today is going to be the cumulative log return here. And so this sort of represents the log price if you'd invested $1 way back here in 1885. The red indicates, using these algorithms, what you would classify as a bull market. So an increasing stock price, and the white here is the bear. So the top one is the Bribosian, and the bottom one is the Lund Timmerman. You can see they're both pretty similar. You can see there's some differences, though. There's some differences in these periods here. There's some differences over here, and there's a little bit of a difference here. So if we look at it a little bit finer, you can see here in terms of the dates of when we have a trough or a peak. So a trough would be the bottom of the bear, the peak would be the top of the bull market. And you can see there's cases where they're close, but if these were exactly the same, then all of these dates in these two columns should exactly line up. What you see is you tend to see the BB algorithm tends to have more switches. Okay? So what does this mean? Well, okay, first of all, this is an ex post historical approach. This means after we observe the data, we could kind of go back and look and sort things out. What does it tell us about, for example, today? Well, it doesn't. The problem is, to say anything with these algorithms, you need to have data ahead of you and behind you to say anything, to indicate a peak or a trough. So it's not very useful in terms of saying anything where we are today. In other words, we can't use these sorts of approaches in real time, even though you might think you have an idea where we are today. It's a difficult method. The other issue is, when you look at this, which method is better? Which of these algorithms would you want to use? What criteria would help you decide which one is better? As I mentioned, we can't use these in real time. We can't forecast what's going to happen in the future. If we want to take a position, we'd like to know, well, what's the market going to be a week from now, a month from now? Is it going to be a bull or a bear? Should we invest now? These things we can't do. The other thing is, there's no sort of regime dynamics. What's the probability of moving from a bull to a bear regime? It doesn't really tell us anything like that. Another issue, too, is we want to know about expected returns. We want to know about risk. What's the mean and the variance of returns in a bear market, in a bull market? These sort of approaches say nothing about those things. So what we want to have is a model that's capturing these trends, but also saying something about the complete distribution of returns. Because at the end of the day, that's what we want. Everything from a financial perspective comes from the distribution of returns. Okay, so let me try and say just a little bit about the sort of econometric model that's operating in the background, and if it doesn't help, well, we'll be getting to the pictures in a few minutes, and if it does, maybe, well, that'd be great. So Markov switching. Well, Markov was a Russian mathematician, and he came up with this idea: if you wanted to model a process through time, he came up with an idea where if you want to forecast tomorrow, if you condition only on what's available today, all you need is today's information. That's called a Markov process. So we say that's Markovian, for example. This is a Markov switching model. So it means if we want to predict tomorrow, all we need to know is today. And that's a class of stochastic processes. So what we're going to do here is we're going to go back and we're going to think of the data here. Maybe I'll go to this one. We're going to use a two-state variable. We're going to think about declines. We're going to call that a 1 or a 2, and increases. Increases are going to be a 2, and declines are going to be a 1. And so what we'd like to do is we'd like to sort the pieces of the data here into states where the price is increasing, states where it's decreasing. And so we're going to introduce this S variable that's going to do the job for us. So 1 is going to be a bear market, 2 is going to be a bull. And so then a bull or a bear market or a run would consist of sequence of these variables happening. So for example, this would be a bull market, and it would last for 4 periods. This would be a bear that would last for 4 periods, and it's switching into a bull. So the S variable here is the key thing that we're interested in. We have to say something about how S is going to evolve. If we're going to forecast, we need to say something about what's going on. And here's where our friend Markov comes into play. We're just going to make a very simple probability statement. We're just going to say that the probability of a bear, given that yesterday was a bear, is this parameter P11. And that's just going to be a probability. So if the probability is 0, that means we're not going to be in a bear. If the probability is 1, it means if we knew we were in a bear, with certainty tomorrow we're also in a bear. Okay, and then we'll have numbers like maybe 0.9, for example, which means if we're in a bear, we're very likely to stay in a bear. Okay, and as that number decreases, for example, 0.5, that would indicate if we're in a bear yesterday, today there's half a chance of being in a bear, and there's half a chance of being in a bull. Okay, I see some intense faces. That's maybe a good thing. Similarly here, we have the probability for a bull. And so we have to parameterize this also. So these are the 2 key parameters that determine the evolution of this S. Okay, and this is the key building block. And so this is what's called a transition matrix. And these 2 parameters here are the key parameters. This is our P11 and our P22. And so what happens is we can be in a bear today. We can stay in a bear. This is the persistence parameter for bear. This is the persistence parameter for bull. We could be in a bear today, or we could exit a bear, which means we go into a bull. And then once we're in a bull, we have a chance of staying there or of exiting and going into a bear. And so this thing here is the key thing to keep an eye on. So we're going to be looking at these ones on the diagonal. If these are greater than 0.5, then we would say the markets, the bull or bear market, is persistent. It tends to persist many periods. So that's sort of the background. Feel free to ask questions if I can clarify any of this. So here's just a simple example. So that's just the S variable, but we want to couple this with a distribution for returns. So we're going to model returns conditional on this S variable. And so this is the normal distribution, and it's going to depend upon whether we're in a bull or a bear market. The mean is sensitive, and so is the variance to the state variable. So I've just taken a very simple example, and I've parameterized here the bear market with on average, negative return and a standard deviation of 4.42. And I have a bull market here that has a positive mean and a much smaller volatility level of 1.6. Then we have a transition matrix here. So on average, 90% of the time when we're in the bear, we stay there. 10% of the time we exit to a bull. When we're in a bull market, 97% of the time we stay there. 3% we exit to a bear market. Okay, so that's how that works. And what's nice about this model is we can derive features from it. So for example, we could say, well, if you just sort of looked at any historical period and put your finger on that red line, what's the probability that was a bull or a bear market? That's the answer from this model, is right there. So the answer is 77% of the time you're in a bull market, on average, according to this model. You can also look at other things like what's the expected duration of a bear market according to these parameters here? Well, it's 10 weeks. What's the expected duration of a bull? It's 33 weeks. So you might say, well, that doesn't fit your idea. That doesn't fit what you think the data is. But the point is, we can use this model with different parameters to back out features of what bull and bear markets are. And that's the attraction here of using this structure. Okay, so here's an example then of these 2 distributions. So we have the distribution for the bear and the distribution for the bull for this example. The bull has a slightly positive mean, much lower standard deviation. The distribution for the bear is slightly negative, has a slightly negative mean and a much larger variance. And so our task really is to go through the data and to try to estimate these parameters here. We want to estimate these parameters rather than just assume them. Okay, so I just did a little simulation here just so you can see what's going on. So I simulated on the computer a sequences of random S's according to this Markov chain. And what we have up at the top is we start out in state 1. We switch up to 2 for a short period. We're back in state 1. We're in state 2. These are alternating bull and bear markets. We then, once we have the S, we take draws from the distribution of returns, conditional on the S. This is the returns we generate. Okay? And you can see then this is the log price to give us an idea here of what's going on. Bull markets generally are increasing, but not all the time. There's randomness involved. And so hopefully I've convinced you that this is sort of, the flavor of this is really what we want in terms of tackling this problem. We need to model the trend in the data, then we need to model the whole distribution of returns. And so there's two processes here. There's the S and the return that we're working with here. And this produces the features that are in the data. The question is estimating these things and seeing how well it works. Okay, so hopefully that's your 10-minute review of Markov switching models. There'll be a test on that next day, but for the moment we'll just press on. So this is just a summary. This is the transition matrix, and this is the return distribution conditional on the state. And we're going to impose two restrictions. We're going to say that the mean of the distribution in the bear state is negative. The mean in the bull state is positive. That's the only restrictions we're going to impose. Then we're going to estimate the model. And we're going to estimate the means, the variances. We're going to estimate this thing here. And we're going to try and figure out what the data told us was the states also. And so I'm not going to get into the estimation process. There's a way to do that, and it works well. So here's the estimates. This is what's called a posterior mean. So we can just focus on this number here for our purposes. But it says that on average, these numbers are calibrated to the, the simulation that I did was calibrated to these estimates. So what we're seeing here is that the bear market is about 3 or more times volatile than the bull market. So the standard deviation is 4.42 versus 1.64. We see that the probability of staying in the bear market is 0.94, while the probability of staying in the bull market is 0.99. So bull markets are much more persistent. Means they're going to last longer. They're going to tend to last longer. So these are typical results. You can run different models. You'll find similar types of things. There's some issues, though, with this model. One is that when you think about bull and bear markets, you think of sustained periods of these markets. And when you look at estimates of the state variable S, you'll find that this model switches too frequently between bull and bear markets. And the problem is, every time you have a negative return, the model thinks that's a bear market. Okay, it thinks that's a bear market. So things like short-term reversals are missing. And so the next step then is to move to a market that has bear rallies and bull corrections. This will produce a more realistic model here. So you did well with the two-state model. It's time to move up a level to the four-state model. And so this is a specification that's a bit more advanced, and what we've introduced here now is a bear rally state that gives us an on average positive return, and a bull correction state, which gives us an on average negative return. Everything else is the same. We're going to think of amalgamating these two states and calling this a bear state. We're going to aggregate these and call it a bull state. But once we're in, actually I should call these are going to be called regimes for clarification. So this will be a bear regime, this will be a bull regime. But once we're in one of these regimes, we can cycle between states 1 and 2 if we're in a bear regime. If we're in a bull regime, we can cycle between 1 and 2. So this is going to produce much more reasonable structure in terms of what we see. So I don't know if this is helpful or not, but let me just say our transition matrix is bigger now, and so again, we're going to end up cycling. When we're in a bear market, we're going to tend to cycle between rallies and downturns, and then sometimes we're going to escape to a bull market. And so we come down here, we're going to tend to move and cycle in here. We're going to cycle between the positive growth of the bull and then the bull correction. Okay, and those are going to be the constituents of the two main regimes. Again, we can back out the unconditional, the on-average probabilities of each one of these states, and we impose this other restriction in our model that if we're in a bear regime, it on average should deliver a negative return. If we're in a bull regime, it should on average deliver a positive return. And this is necessary for identification purposes. So here's what we get in terms of estimates. We've imposed these restrictions and we get this sort of structure. We get sort of an interesting result in that the bear state negative growth is the most volatile, followed by the rally state being the next most volatile, until we get down to the growth state, the bull growth state, which is the calmest. So variance here turns out to be important in identifying bull and bear market trends, and we'll see this a little bit later. And again, what's happening is you're cycling dynamically through here in these periods, you're escaping and you're cycling in these periods. Okay. What about the unconditional probabilities on average? What is this model saying? Well, on average, we're spending about 77% of the time in a bull and about 23% of the time in a bear. And you can see here, this is the bear rally. We spend about 16% of our time in there. The bull correction, we spend about 30%. Okay? That's what this model is saying. These are a few statistics before we get to the pictures. They tell us the bear mean, the expected duration. So these are in weeks. So this is a little over a year. A bear market is expected to last a little over a year. On the other hand, the bull is expected to last just about 5 years on average. That's what we're estimating. You can see the cumulative returns here. In the bear state is compensated then by the rally state. The bull is offset again by corrections sometimes. So there's a whole host of statistics we could go into and talk about, but we'll save that for another day. Here's the 4 distributions that we estimate. So each of these are normal with an associated mean and variance. And here is the state 1, which is the bear negative growth, and all the way up to the bull positive growth. And you can see again, as you move from the undesirable bear markets to the desirable bull, there's a shrinking in the variance and there's a movement towards the mean being positive. If you wanted to aggregate these two distributions, then what we're saying here is you end up with a bull market distribution that's the green one, a bear market distribution that's this one that's spread out, has a negative mean. And then if we aggregated these together on average, then that's what the distribution of returns overall is in this model. Okay, so here's a plot now of an estimate of the state. So what we would like to do is we'd like to estimate what is the state. When did we have a bull market? When did we have a bear market? So the top panel here is the cumulative log price over time. And the red is the Lund-Timmerman sorting algorithm. The next thing we have then here is the probability of a bull market, which is the probability of state 3 and state 4. Okay? So when this is close to 1, this is indicating almost with certainty that we're in a bull market. When it's close to 0, for example, down here, it's saying we're likely in a bear market. Okay, so this is a historical sorting. This model down here is exactly the same thing, but it's the two-state model. So this is the model I'm focusing on. This is the model I introduced first. And one of the things you could see, this tends to produce more precise sorting. There's less switching. There's a lot of switching in the two-state model here. And again, that's primarily due to outliers. So the model does well overall in terms of these things. And let me maybe show one or two examples. So you can go in and look at the data. Here's an interesting period of the 29 crash. So here's where the crash started, and it was sustained over the 30 due to poor monetary policy decisions and various other things that contributed to it. That was the Great Depression. In terms of what this model is saying, is it's saying we decisively entered into a bear market here. So this is the probability of a bull market. So when we have 0, that means we're not in a bull, we're in a bear. Okay, and then so we were in for basically a decade and came out, just before the start of the World War II. And so what's going on then inside this is what a conventional model might produce, is we're getting periods here where we go from a bull positive growth state to a bull correction here. And the bull correction then moves in to the bear negative growth. The bear negative growth then moves into a bear rally, and eventually here, when we start to come out of things, it's through a bear rally state. Okay, so I've got some other examples, but in the interests of time, let me focus on this one. So this is the recent financial crisis, and you can see here roughly we date the start of the bear market in September of 2008, and that was coincident with the Lehman Brothers collapse right around that period. And you can see here the dynamics. This tells us that we were clearly in a bull market, but what was happening is we were oscillating between corrections and the positive bull state. And eventually the correction here turned into a full bear market. And then finally coming out of this, we end up moving into a bear rally state, and that turns into a full-fledged bull market. Okay, so the sorting of states with this algorithm, this econometric approach works very well. And we see lots of bear regimes here being a recurrence of states 1 and 2, which are the bear and the bear rally. Similarly, a bull regime, we see lots of movements between the bull state and the bull correction. And I think that intuitively works very well. It's what people expect, what they anticipate, and then what they see in the data. So this model speaks to that directly. One of the interesting things here is when we look at turning points, moving from a bull to a bear or vice versa, how does that tend to happen? Well, it tends to happen through these new states we've introduced, the bear rally and the bull correction. So those are very important states in terms of turning points. Okay, so this was all historical data. Well, what about if you want to do this in real time? So there's some results in some of the papers I'll list at the end which show us how to do predictions of the distribution, how to look at the predictions of cumulative returns, which actually do rather well under this model because, not surprisingly, we're focusing on trends are important in the long run, and also predictions of the states. So, excuse me, let's look at a particular example in real time. And we're going to estimate the model over this financial crisis period and estimate the state and estimate the value at risk, which is going to be the 5% quantile, which you might compute as a simple risk measure. And we're going to compare it to a value at risk that you would do just by taking the sample average and the sample variance and plugging that into a normal distribution. So let's look at what happens. So the model is re-estimated through time. We went back, we estimated it, I can't remember, from 2007 onward, and then we would do a prediction, we'd re-estimate it, we'd do a prediction. So the top panel here has our observations during this period. This is the value at risk. This is the amount that we'd expect to lose 5% of the time. This is, the green line is from the model. The dotted blue line is just from the simple normal approximation that you might do in Excel using historical data. And you can see the value at risk performs very poorly around the financial crisis. On the other hand, our model predicts decisively a change in regime in real time in early October. So in early October 2008, this model would have told you we're in a bear market. So you could use that information to make adjustments in your portfolio and your decision making during that period. And you might actually want to make those decisions earlier because the model indicated some uncertainty before 2008 October. And so you can see, though, this has implications for value at risk. So risk measures are very sensitive to these regimes. That's the point. Okay, so let me finish off then with where we are today. So most of the work I presented, I think, was based on data up to 2010. And so I've updated the data here, re-estimated the model, and this is as of last Wednesday. We end up with pretty strong evidence that we're in a bull regime right now. And what are the constituents of that? Well, there's about a 70% chance that we're in the attractive bull market state with positive growth and low variance. And there's about 30% chance we're in the bull market correction state. But the good news is this probability is pretty large, and if you remember the model, we're going to tend to cycle between these two things. So the model at least is saying the good times are here. So let's just look finally at a plot of what has happened recently. And so this is the log price process here. And there was a period, an episode in 2011 that we had strong evidence here of a bear market. But most of the time we've been in a bull. And you can see the indexes have been increasing. It's classifying these things as bull corrections. These are bull corrections. This is a bear here. So we came out of the bear, and we came out of it with a bear rally. That moved into a full bear, and we've been switching between bull positive state and bull corrections since then. Okay, so there's a bit of a summary of some of the things we've talked about. A 4-state Markov switching model, and the key thing that it has is it allows for rallies, bear rallies, and bull corrections. And this results in a much more realistic model and more accurate dating, sorting, and forecasting. Out-of-sample forecasts do well in turning points. You can use this thing in real time. And I think I've said most of what I want to say. So let me finish with some references in case you want to find out more about Markov switching models and all that fun stuff. And I will leave it there. Thank you.